Okay, let's dig into this. Something feels a bit, well, off in the financial markets right now, doesn't it? We're seeing the Japanese yen, the JPY, actually getting stronger.
Yeah.
And this is happening at the same time that yields on U.S. Treasury bonds are climbing.
Right, which is the weird part.
Exactly, because, the usual playbook says these two move in opposite directions. Higher U.S. yields. That typically boosts the dollar against the yen.
Pretty much always. So yeah, what's the story here?
Well, what's really fascinating, potentially, is that this break from the norm could be a pretty big signal about maybe how global economic perceptions are shifting.
And we've been looking at this report from Deutsche Bank, from strategist George Saravelos. He's really been zeroing in on this exact thing.
He has. And it was actually you, our listener, who flagged this analysis for us. You wanted to get a handle on what this unusual currency move might be telling us.
Makes sense. It's a puzzle.
So our mission for this deep dive is to really get under the hood of this market quirk, I guess. Understand Saravelos' take on it.
And figure out what it could mean, for the U.S. economy, for investor sentiment globally.
Yeah. So let's jump right in. What's the core anomaly? What's Saravelos really highlighting here?
Well, the main thing is this breakdown of the usual relationship, that seesaw effect between the USDJPY rate, basically how many yen per dollar, and U.S. Treasury yields.
They normally go opposite ways.
Exactly. But now, instead of that inverse relationship, they seem to be moving almost together, the yen's strengthening, while U.S. yields are also rising. And Saravelos himself put it pretty bluntly. He said, and I'm quoting here, the yen is strengthening even while U.S. yields are rising. This is not normal.
Not normal.
Yeah.
That really stands out.
Yeah.
That historical link, that inverse correlation, it's been such a reliable rule of thumb for ages, hasn't it?
It really has. Higher U.S. yields, that makes dollar assets look more attractive.
Sure. More return.
Right. So international investors buy dollars, dollar goes up, yen goes down relative to it. Simple mechanics, usually.
But the fact that it's not playing out like that now, it suggests maybe something fundamental is changing, either what investors are focused on or perhaps what they're worried about.
And Saravelos, he has a main theory for what's driving this. And it hits on something that's, it's been in the headlines, the U.S. fiscal situation.
Okay. Government debt, spending, that sort of thing.
Precisely. He thinks this strange market behavior is basically a sign of growing nervousness among investors about the U.S. government's financial health, its footing.
Wow. And didn't he say it was like the most important signal to watch?
Yeah, he called this gap, this divergence, the most important market signal to watch right now, which is quite a statement.
It is. So if we connect the dots, a stronger yen, that's often seen as a safe haven move, right? Or maybe a sign investors think Japan's economy is looking relatively better.
Sort of. But for the yen to get stronger, even when U.S. yields are offering better returns, that suggests something else is more powerful than that yield difference.
Okay.
And Saravelos is arguing that something else is this growing worry about the long-term picture for U.S. fiscal policy. The sustainability of the debt path.
Right. And we have seen other whispers about that, haven't we? Concerns about U.S. debt, rising entitlement costs.
It does make you wonder if this yen move is maybe an early canary in the coal mine, a signal of a wider rethink happening under the surface.
Okay, but hang on. What about Japan itself? I mean, Japan has a huge amount of government debt, famously so.
True.
And the report mentions Japanese government bond yields have been ticking up, too. That 30-year yield hit, 3.19%? Highest in 25 years?
Yeah, that's a significant move for JGBs.
So couldn't that be it? Could the strong yen actually be a sign investors are worried about Japan's debt?
It's a fair question, and it's one Saravelos addresses head on.
And what's his take?
His logic is pretty simple, actually. If the market was genuinely freaking out about Japan's own debt situation, the yen would likely be weakening, not strengthening. Investors would be selling yen assets, moving money out.
Okay. Makes sense.
As he puts it, again quoting, if investors were worried about Japan's debt, the yen would be getting weaker, not stronger.
Right. So that kind of rules out the Japan worry explanation, at least according to him.
It seems to. Which puts the focus squarely back on the U.S. side of the equation.
So if it's not about Japan's debt, what does Saravelos think this broken link tells us specifically about the market for U.S. government bonds, for treasuries?
Yeah, this is key. His view is that this decoupling, this break in the pattern, it suggests foreign investors are maybe pulling back a bit.
Pulling back from buying U.S. treasuries.
Yeah.
even with higher yields.
That's the implication. The traditional pull of those higher yields just isn't packing the same punch as it used to, apparently. He states it pretty clearly. We think this shows that foreign participation in the U.S. Treasury market is going down.
Foreign participation going down.
Yeah. And, we saw dynamics that were sort of similar, maybe back in the late 90s with some emerging market bonds, though the reasons were different then. It's just a reminder that these market signals, they're important, but maybe not always straightforward, need context.
Definitely. Okay, so this is where it gets really intriguing. If global investors are starting to maybe buy fewer U.S. treasuries, what are the bigger consequences? What are the ripple effects we should be thinking about?
Well, the analysis really flags this as potentially quite significant. It's not just some minor currency fluctuation.
Right.
It could be, and this is the term used, a warning sign.
A warning sign about what specifically?
That global investors, maybe as a group, are starting to have some doubts. Doubts about the U.S. approach to managing its finances, its fiscal policy.
Wow. So a potential loss of confidence.
That's the underlying suggestion. And if that shift in thinking continues or gets stronger, yeah, it could have, quote, major effects on currencies, bonds, and investor sentiment going forward.
Major effects, okay.
So what Saravellis seems to be suggesting here is, look, this could be an early indicator, an early signal that the world's perception of U.S. fiscal strength might be starting to change.
Okay, so let's try and distill this down. The key takeaway from digging into Saravellis's analysis seems to be this. This weird situation, yen getting stronger while U.S. yields rise. It's a really notable signal, potentially a concerning one.
Right. It points toward the scenario where global investors might be getting increasingly worried about U.S. fiscal stability.
And that worry is somehow becoming more important than the attraction of higher U.S. interest rates.
Exactly. It's outweighing that traditional link. And it could also mean less foreign demand for U.S. government debt overall.
So this definitely raises a big question for you listening right now.
Yeah. Given this potential shift in sentiment that Saravellis is highlighting, what other economic signs, what other indicators might you start watching really closely now?
Good question. Like what data points could either back this up or maybe contradict it?
Right. Maybe things related to inflation expectations or how U.S. debt auctions go, who's buying.
Or even just broader capital flow data, seeing where money's moving globally.
Exactly. Things that might confirm or challenge this idea of potentially fading global confidence in U.S. fiscal policy. It really makes you think about how interconnected everything is in global finance.
Absolutely. Look, this deep dive based on George Saravellis' analysis, it gives us a really valuable snapshot, a glimpse into a potentially major shift that might be starting.
But as always, the economic picture is complex. It's always changing.
Definitely. So your own continued digging into these dynamics is, well, it's essential if you want to understand what might be coming next.